Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this video, we're going to talk about a very important planning concept for retirees, which is this idea of layering retirement income. So if you're trying to figure out how to structure your income streams for retirement when you get there, or maybe you're already retired, you'll find this video very helpful. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement planning and overall wealth planning. So if you don't want to miss future content, hit subscribe. If you like this video, hit like. And if you want to find out how to get your own complimentary retirement plan, visit the show notes for this video. There's a link to our website so you can find out more about how you can get your complimentary retirement planning forecast. Okay, let's talk about this concept of income layering. So the idea of income layering for retirement planning really involves three major steps. They're pretty basic. The first thing is determine how much retirement income you're going to need, specifically really how much after-tax income you need to have coming to you on a regular basis. Secondly, you have to identify what will the income sources be, because once you identify that, you can have a pretty good idea about how you need to layer that income. And third, you need to begin devising an income stream from those sources to meet your cash flow needs. So that's the basic three-step process. Now, the general rule of thumb is you want to first utilize income streams where you have the least amount of flexibility and are probably the least tax-efficient income streams. So you'll use those sources of income to look after your basic income needs. So what are those sources? Well, typically it's going to be Canada Pension Plan, your old age security benefits, possibly annuity income that you have, employer-sponsored pension income, and then mandatory minimum requirements you'll have to take out at some point from your registered retirement income fund, your life income fund, or restricted life income funds. So if you have that as your basic starting point, then you'll know what that level of income is going to be, and then you can begin structuring other income sources to look after any potential shortfalls that you might have. So once you've identified those income sources, again, you want to start your basic income requirements. That's the first layer. These are tax inefficient income streams. You want to start taking those right away to absorb that income at a lower rate of tax. Now, once you do that calculation, you'll have an idea of how much income you're generating. Any shortfalls then will have to come from your personal savings. So those savings can be from your RSP RIF accounts. It could be from your tax-free savings account. It could be from a non-registered investment portfolio, as an example. So there would be a range of investments maybe you could dip into to fund the shortfall. Now, there may be some other income sources as well when you look at this layering strategy. Those could be rental properties spinning off regular income. It could be inheritances or gifts that you think would be reasonably in the mix for your own particular planning. Maybe you have a business that will be sold, or maybe a business that will be operating on an ongoing basis and spinning off a little bit of income for you. And then you may have other personal assets you might be selling. Maybe you have a property, maybe a rental property, maybe a recreational property that at some point may be sold, and that could be used to layer income into your planning. So again, begin to brainstorm what, if any, of those income sources might be part of your planning. Now, as you look at the different layers of income, it's probably self-evident, but as you begin increasing your income, you potentially will be moving into higher levels of taxation, or what we refer to as marginal tax brackets. So that's why the layering in the hierarchy of which incomes you draw first and then the subsequent incomes is really important. So again, if we review the federal tax rates in Canada, you're at the lowest rate of tax up to just over $50,000 per year, roughly a 15% marginal rate. Now, you've got provincial tax rates on top of that, but that gives us a basic idea. On income between $50,197 and $100,392, you're at the next bracket. The overall marginal rate on that income would be 20.5%. And if you have income between $100,392 and $155,625, you're going to be at 26%. Now, for many retirees, they're going to be caught either the first or second tax bracket. So what I typically find, especially with regard to pension income, which can be split between spouses. If you have a partner, you can absorb more income because you can split the income from tax purposes. You know, there's a lot of couples out there where if each of them have upwards of $50,000, that's $100,000 of pre-tax family income, they're going to be at the lowest tax rate. And for most families, that's going to be the case. But if you need to begin generating income above that $50,000, that's where you have to start paying attention to the tax rate. So once you bump that rate, you're now upwards of another 5% taxation for the individual. So those are the things we'll need to keep in mind when we look at the layering of income. So at a high level, if you run your budget, and let's say you have a partner and each of your incomes is at that $50,000 level or less of taxable income, you're going to be at the lowest tax bracket. But let's say you have some other expenses coming up, maybe some travel expenses, maybe you have to replace a car or renovation on your home. And if you take money out of your portfolio, it could bump you into the next bracket. So an example is, at that level, you don't want to be taking more money out of your registered account. So your RSP account or your LIF account or PRIF or Registered Retirement Income Fund. So hopefully you've got other monies you can access. So you might go into your tax-free savings account, which would be a tax-free withdrawal. It doesn't move you into another tax bracket. Maybe you have some non-registered investments, some GICs, cash accounts, or maybe some investments in the stock market where although the sale of your stocks or securities might be taxable, it's going to be in the form of a capital gain, which isn't taxed as high as regular income. So you have to begin strategizing. So when we work with clients on the retirement income modeling, that's exactly what we're going to be doing. We take a look at the income streams, we look at the layering strategy, and we begin to visualize which accounts need to be accessed to provide the cash flow on an after-tax basis you need without doing it in a tax inefficient way. So if you look at this chart in front of you now on the screen, you can see on the left-hand side we've got the least tax efficient investments. Again, that's government benefits, old age security, CPP, employer-sponsored pension plans would be next. And as we move right on this chart, now you've got your minimum requirements from your RSP accounts, and then you've got maybe additional income you're taking out from the RSP. Now, why would you take additional above the minimum? If you can absorb additional income from the registered account and it doesn't bump you into the next tax bracket, it actually makes sense to look seriously at that strategy. Pull the money out at the lowest rate, pay the low rate of tax, and if it's surplus to your needs, then you might be able to push that into your tax-free savings account. Now you've moved the money into an environment where it's growing tax-free instead of tax-deferred. Next, we've got tax-efficient distributions from a non-registered portfolio. So your open investments might be in securities or investments that are generating dividend income. Capital gains might get triggered, which is tax-efficient, and then maybe some interest income. We have next what's called a T-SWIP investments, which are tax-effective income streams from non-registered holdings. I won't talk about that today in this video, but that can be a separate video. We can talk about that area. Tax-free savings accounts on the furthest right there, not right at the end, but the second from the end. Obviously, anything you take out from your tax-free savings account is tax-free. It doesn't trigger any additional taxable income. And then finally, non-taxable receipts. What could that be? It could be the sale of your home. It could be an inheritance or a gift. Those might be some common examples. So at a high level, figure out what you need. What's the after-tax income? See where those basic non-negotiable income streams are going to take you in terms of the tax bracket. As you move into another tax bracket because other expenses are coming up, then you have to begin strategizing a little bit in terms of how you'll tap into other assets tax effectively to generate the income that you need. Well, it's my hope that you found this video helpful. Income layering is a very important part of planning, and like I said, if you have someone doing some financial modeling for you, you can see actually visually when that modeling is going to come in handy in terms of the layering strategies. If you're not clear on this area and you're trying to seek clarity around the income plan and how layering plays a role, again, go to the show notes for this video. There's a link to our website. You can find out how you can get a complimentary retirement plan. And part of what we do is look at the layering strategies for you. As well, if you're new to this channel, make sure you hit subscribe so you don't miss future content. And if you like this video, make sure you click like. Anyway, wishing you all the best in your retirement planning journey and overall wealth planning. You take care. Bye-bye.